honor to be in front of you. I speak to you both as a European. I was born in Barcelona a few years ago, and now I'm a U.S. citizen. So both as a European and as a American citizen, I'm sending you all my solidarity, and hopefully I'm going to teach parts of what I teach usually in my regular classes, but more geared to an audience that is focusing on reconstruction. So my name is Albert Saiz. I'm at the Massachusetts Institute of Technology, and I'm the Daniel Rose Associate Professor of Urban Economics and Real Estate here. So my research is focusing on housing market and urban development. So let's think a little bit about how economists think about cities. Whereas cities are complex, you see people, you see economic activity, you see beauty in cities, you see relationships thriving. But economists tend to think of cities as supply from a supply and demand perspective. So when you look at a city, we are focusing on the supply of housing in the city. So here you have these two different axes. The x-axis is showing you the housing stock in the city, the number of housing units in the city, and on the y-axis you have the housing prices on a city. And then we think of the demand for the city. So the more expensive a city is, the lower the demand. So in a city such as New York, Barcelona, Singapore, a lot of people would like to live there, but it's too expensive so that not everyone who wants to live there can afford to live there. And then you have a housing supply, which means that the more expensive the city becomes, the more profitable are the development projects in that city. You cannot, as a developer, build something in the city if you don't get enough money to make some profits. So that's the way we're going to think about cities, and that's the way I want to invite you to think about cities, just for the economics of reconstruction. Obviously, there's many other things that have to do with human lives and social consciousness, and obviously the politics are important too. But I want to invite you for the next 3 hours to just focus on the economics. And focusing on the economics, I think it's really important to really look at the supply and demand for, say, housing. Now, when I say housing, I also mean commercial real estate. You could do the same graph for the demand for factories, for the demand for office real estate, for the demand for hotels, so on and so forth. So it's going to be a very similar type of paradigm that I want to introduce you. Now let's focus on the supply of housing. And here, you're going to have some kind of equilibrium between demand and supply. So if that's the supply of housing and that's the demand of housing for that city, you're going to end up with a construction level of Q0 and a price of P0. Now, obviously, sometimes you're going to have changes to demand. So think about a city such as my own hometown city, like Barcelona. We had increased housing demand. Why is that? Mostly because the city was very oriented towards the IT sector and towards tourism and attracting people because of the high quality of life. So once you have these two factors driving the demand, people want to move to Barcelona. So that's going to increase, you're moving along this line here, it's going to increase the demand for the city. And because you need higher and higher prices in order for you to build more to accommodate that demand, the city is both growing and becoming more expensive at the same time. So that prices start at P0 and go to P1. As a matter of fact, Barcelona would be a city where the slope of this function, which is the housing supply function, would be much steeper. So you'd have a much higher effect on prices as demand goes up than you have on the supply of housing. So let's try to understand where the supply of housing is going to come from. And that's critical for reconstruction, because a lot of what you guys are going to do is to rebuild real estate and specifically housing. One of the things to understand, and that's a critical point for the whole lecture, to understand from the supply of housing, is that in a market without any subsidies, absent any subsidies, the minimum amount, the minimum level, the minimum price at which the housing is going to be produced is at the construction cost. So if it costs 100,000 euros to build a house is not going to be built unless the prices in the market are above 100,000 euros. So the construction cost really signifies the minimum price level that you start at the housing supply function. And then after that, as the city increases and you increase the supply in a normal market, in a market that does not been as affected as your market by catastrophes, you're going to tend to see the land, the difference between the construction cost and the price of the assets, the real estate assets, specifically housing, the difference between these two, it's going to be the implicit land value. So in a regular city, growth happens only when prices are above the construction cost or the replacement cost. After that, then land values grow. The difference between this green line, which signifies the construction cost for the housing, and the actual prices of homes, it's going to be the growing land valuations that as you have more and more competition for the better places of a city, you're going to start having the land values grow farther and farther up. So now that's the framework I wanted to introduce you. We have a supply for housing and real estate. Again, it can be commercial, it can be office, it can be factories, and a demand for the city. Now, there's something that's very interesting about housing markets. Housing markets are not like orange markets, wheat markets, oil markets, because you build housing and the housing is going to be built for a long period. So it might, depends on the type of housing. Here in the United States, we build boot homes, and we expect the deterioration or the sort of depreciation to be relatively fast. In Europe, it's mostly brick homes, so you tend to believe that homes there are going to be sort of living or standing for much longer times. Whatever it is, again, if the prices for oranges are very low, what's going to happen is that the producers are going to stop producing oranges for next year, maybe change from oranges to something else, or from wheat to soy, perhaps in the next 2 years. So you're going to have the supply of soy, for instance, if the prices of soy in the soy market, in the global soy market go down, the supply of soy is going to adjust downward. In the housing market, we don't have this phenomenon. In a normal housing market, once you build something, it's going to stay put. So at any point, if you start with an equilibrium in a metropolitan, and this might be a city, think about any specific city like Warsaw. So if you're in Warsaw and you start at this price level, you're going to see this construction level. And this construction level, it's not going to change down necessarily, because all the things that you built in brick and mortar are not going to disappear from one year to the other unless you have a catastrophe, which we're going to talk about later. So what we tend to, the language that we tend to use in housing economics or in real estate economics is that housing is durable, and the housing supply, it's kinked. It has this weird shape where you have generically over very long run periods, as demand goes up, you're moving along the supply function. But if there's something negative happening to the city, then the supply becomes completely fixed. So let me show you an example here. Now assume that we have a city that experiences a negative shock, a negative demand shock. Something sort of happened to, say, the economy of that city. You can think about a city like Bilbao, also in northern Spain. It used to be an industrial city in the 50s, 40s, 50s, 60s, had a very large industrial production base. But after the 80s, we have the globalization phenomenon, and you start having South Korean, Japanese, and then later Chinese firms competing with these Spanish firms. And then you have this employment in Bilbao declining, so the demand for the city goes down. What's going to happen initially with that decreased demand for the city is that a lot of the effects, because you cannot destroy necessarily the real estate, it's already being built and it's very durable, a lot of the effect of that reduced demand, it's not going to be on the changing construction in the short run. It's going to be on declining prices for real estate. As a matter of fact, you can argue that some of the attraction of these cities. So why didn't everyone leave Bilbao? Well, because it's a very cheap city. Okay, because the real estate becomes very cheap in a city like that. You can think of the same in any industrial city in Europe that went through deindustrialization, sort of like Lyon, Torino, Glasgow, Liverpool, Manchester. Those cities didn't disappear immediately; they did decline, but because real estate and housing became so cheap, that still attracted people to stay in these areas. Now, and that's a very important argument that I'm going to make for you guys in Ukraine. A bad case scenario is when this demand declines. Sort of think about a city like Glasgow in the 1970s. I'm not sure to what degree you know what the problems were with the industrialization in the UK in the 70s, but we had a lot of problems, or they had a lot of problems with the industrialization because of globalization. The UK used to be a very industrial country, but in the 60s and 70s, Hong Kong, Korea, Japan, and then eventually China start producing a lot of the same products like shipbuilding, steel, and very heavy industrial products, which means that Glasgow is becoming less competitive, which means that people start leaving because there's no jobs. As jobs go down and decline, you have that demand for that city, that red line that I'm calling here D0. Remember here that I have housing prices, just to refresh, on the y-axis, on the vertical axis, and the number of housing units on the horizontal axis. And in the long run, you started in Glasgow in 1960 in a very good place. You had, maybe 3 million, 2 million, whatever it is, buildings, and the price was sort of relatively high. Unfortunately, with the industrialization, what eventually happens is that you move from a relatively high demand to a relatively low demand. That would be signified by the shift from D0 here to D1, where the demand for the city, people are moving out of Glasgow. They don't want to live there because there's no jobs. So people go exiting the city. What's keeping the city from completely going to zero population? Well, the fact that the prices are very cheap. Housing prices are declining because housing cannot be destroyed immediately, at least not in a city like Glasgow. I'm going to talk about destruction later. And prices go very low for housing. Now, what is the problem in this situation? And that's a problem that I'm afraid that some of the Ukrainian cities are going to have to face. In this situation here, the prices of real estate, the prices of housing, the prices of factories, the prices for office space are going below construction costs. So you're in a very dangerous situation here because the prices of the asset become below construction cost. So let's think what happens here. Let me go to Glasgow again in 1980. There's a lot of social upheaval. The factories are closing, very high unemployment. You have high crime associated with these issues. And you know what? In this city now, the market value of a house is declined dramatically. So let me give you an example for this. Assume that the housing price in Glasgow is 25,000 euros, but it costs you 65,000 euros to build the very same house. And it doesn't matter whether it's an apartment, it can be a single house, it really doesn't matter. The logic is the same for any kind of construction. So if you're in a situation like this one, and the value of the house is 25,000 euros, but the construction or reconstruction, and that's getting closer to your situation, is 65,000 euros, the private sector, without any subsidies, there's not going to be any new construction. There's no construction because why would, as a developer, so think about the developer, why would I spend 65,000 euros to build something and sell it at 25,000 euros? I would just be losing 40,000 euros by building this house. That's something I don't want to do. Now think about a customer, a potential individual who wants to buy a house. He can go to a builder and he's going to get a quote, or she's going to get a quote for 65,000 euros. But you know what? Why would I buy for 65,000 euros from a constructor if I can buy it from my neighbor for 25,000 euros? So again, that implies also from the demand side, neither the builder or the house owner, the people who want to get a new house, will want to build a new house. So there's going to be no new construction in an area like this absent any subsidies. Obviously, a 40,000 euro subsidies can break that difference. If I pay 25,000 euros and the government pays 40,000 euros, then we can both together, me and the government, pay 65,000 euros to the producer to construct. Obviously, that's something that you cannot do for every house in the city. So, first lesson, when values of housing and real estate, again, this goes also for factories, for hotels, for any other real estate asset, go below replacement cost, the market is not going to provide. It's going to be absent subsidies. Now, there's a second problem, and that comes from some research that I've affected with other people here in the United States, is that we tend to see that when market values go substantially below the cost of construction, people don't put a lot of money into renovations in the house. Why is that? Okay, so think about a house in Glasgow, it's 25,000 euros, and you think about replacing the roof. The roof is leaking, you have problems with the roof in that house, the water is coming down. When it snows, the water accumulates, and then it expands again, and with the ice, and sort of it's all broken up in the attic. Now the problem is that I call my contractor, my builder, and they tell me, oh well, it's $25,000 to fix the roof. And then I compare this $25,000 with the value of the whole house, and that probably doesn't make sense, does it? How will I spend so much as a house? I might as well buy a new house from someone else. Yes, excuse me. Any questions?
It was by chance. You can continue.
So absent any questions, and by the way, I might stop at specific times to ask for questions, so feel free to write them in the chat, and I'll be happy to stop and answer questions. But let me go, and whenever you have questions, then I'll again we're going to get them together when I have stops for questions, if that's fine with you. So okay. Now, why would I spend $25,000 on a roof if that's the whole value of the house? It's not worth it. So the problem is that when the valuations of the real estate stock go below replacement cost, there's going to be a decline in major renovations and investments in the stock. At the end of the day, you can think of it this way. If I had to do a number of renovations and the total cost of renovations is 65,000 euros, which is the value of building the house, I wouldn't do it. It's not worth it. In that case, you're going to see rational abandonment. You're going to see people not making investments in their homes because it's not worth it. Why would you spend so much money on something that you get a negative return? You get less money. Okay? So this has happened in a lot of places all over the world. Again, this is not the situation in Ukraine necessarily right now, but there's a parallel that I'm going to talk about in a few minutes. But you have cities like Detroit. Here, what happened? The exact same situation. So a construction cost for any of these houses may be $150,000, but these houses are traded in the market for $40,000, $30,000. So it's not worth to spend a lot. So that's some of the banlieues in France. That's Glasgow, Liverpool. So a lot of industrial cities had this problem whereby the housing valuations were below the replacement cost of the asset itself. Now, why am I mentioning this? I know that your issue is not with only, the industrial decline, okay? But, that might help us think a little bit what's happened here, okay? Because you have a negative shock in demand and a negative shock in supply at the same time. So what do you do if you're in Glasgow in 1970? What do you do to actually start getting back reconstruction of that city? Well, there's many ways, but if you don't do anything, what's going to happen for sure at this very low price, so remember that this is the long-run supply. We had built so many homes in Glasgow up to the 1960s or 70s, but now the demand, or Bilbao, and now the demand is very low, which means that the prices are below the construction cost. Absent anything, if nothing here happens in terms of supply or demand policies, slowly the stock is going to go on deteriorating because people are not putting a lot of investment into this stock. It's not rational given how low the valuation is compared to the costs of renovations. So slowly, in a city like this, you're going to have a slow decline. So some homes on every year are going to burn, they're going to get deteriorated, they're going to get abandoned, and then slowly, in a city like Detroit, actually, you could argue that the demand decline in the demand started already in the 50s, in the 1950s, and every year for the last 70 years, we had a decline in the population of Detroit as slowly as the real estate stock, the housing, falls apart, burns out, slowly deteriorates. You're starting to move like these parallel lines here. You're not building here at all. The only thing that's making the supply change and decline is the destruction of the real estate stock. So now that's starting to look a little bit more familiar, that you have this destruction of the stock. In this case, I'm still talking about natural destruction of the stock in a post-industrial city. So slowly, the city is going to decline. In this case, you can see that, unfortunately, the city is going to decline all the way to zero. And that was the path that Detroit was following until recently the demand changed. Because even if you reduce the stock to zero, the demand was low enough that there wasn't anyone willing to pay the price that's equal to the construction or replacement cost for building a new housing unit there. So that's problematic, obviously. So now, that's a very nice example here. You see that's exactly how we had these deindustrialization processes in, for instance, the UK, the United States, Italy, Spain, France. To a degree, you could argue that Romania, Bulgaria, after they got into the European Union, because there's a lot of labor moving to Western Europe, you got to be, of course, very careful looking at the situations in Bulgaria and Romania, because a lot of people left. That means that the demand in their local economies was lower for living in Romania and Bulgaria. So you got to really think carefully about how you keep those people and attract those people into your cities. But, again, Liverpool, people moving to London, mostly to southern England. So you have a slowly deterioration from the 60s through the 70s, 80s, and 90s. And slowly you have from a city of 1.4 million, you go to a city of 900 or almost 850,000. Starting to go up now, much more recently, because of the demand side starting to rebound. But again, a lot of this has happened through the deterioration of the housing stock, the deterioration of the real estate stock in this area. So now, let's look at major catastrophes. And unfortunately, that's obviously what's happening in Ukraine, but it's also what happens in Houston with the hurricanes or New Orleans. Here, obviously, there's a lot of thinking about the supply. No, obviously the supply has been parts of the cities have been destroyed, have been deteriorated, and very unfortunately. So you certainly have the stock of housing or real estate in some of your cities has declined, in some cases very severely. So that I represent from the motion of this. Again, remember that this is the demand for a city, this is the supply, but because as you go up with the demand, you're already built so much, going down, the supply is fixed, no? Because if you build already 10,000 homes, those homes are there. They're not going to be necessarily taken out of the stock. But in your case, you did have in some of these cities, unfortunately, a take out of the stock, a destruction of the stock. So this I'm representing, you start with two periods, just for simplification. We tend to be very analytical economists, so we call things 0, 1, just give it a number. So it's easy to distinguish between the two situations. So in the initial situation, this is a city that was doing fine. That were the housing prices, that was the quantity of housing. But now, unfortunately, have major destruction of housing and infrastructure. When I say housing, I definitely mean office spaces, I mean factories, I mean roads, I mean water facilities, I mean energy supply facilities, everything that's real estate and infrastructure. Unfortunately, however, what a disaster, a major catastrophe does, and that's true, for instance, again, with a hurricane or a major sort of negative shock, it also declines the demand. And that's, I think, if I can convey one point, is that reconstruction after a major catastrophe, it's not just about rebuilding the infrastructure or the homes. It's also about rebuilding the demand. Because unfortunately, and we have a clear lesson from New Orleans, so if you look at New Orleans, there was a major hurricane in New Orleans that destroyed a substantial amount of the housing stock. Unfortunately, however, that was already pretty bad. It wasn't something that they wanted to have. But, there was some thinking about reconstruction, how to rebuild New Orleans. The problem, though, is that at the same time, or the challenge, really, the challenge that you have to work on, and they had to work on, is at the same time that the supply had shrunken because of the destruction of the stock in New Orleans, the demand for the city had also declined. People didn't want to move back to New Orleans for some reasons. Some people were afraid because there might be another storm. Some people lost their jobs were closed. It took a year for some people to go back, so there wasn't enough businesses open. So it's a chicken and egg. No, if you don't have customers in New Orleans, why would you reopen a restaurant if you don't have the customers? Huh? But then why people don't move to New Orleans? Because there's no restaurants. So you see there's a chicken and egg, like a causality, a vicious circle that's affecting a city that has such a destruction, because then you don't have the demand either. Because the jobs are not there. So in catastrophic situations, it's not just about that supply. The supply, it's also a challenge to increase that supply of infrastructures and housing and reconstruct, but also that demand for the city. Okay? That's actually gone down because of, again, people moving out and so on. So this is a dual challenge, supply and demand, and the solution's gotta go through both, not just through the buildings and reconstructing the buildings. That's not enough. That's necessary, but not sufficient to get the city back to its track. So now, What happens in these situations if you just work on the demand? So let's go back to New Orleans after the hurricane. Okay, in New Orleans after the hurricane, we know that both the supply of housing declined, and very severely. New Orleans is a good example because we had probably 20-30% destruction of the housing stock. So it's a very significant scenario there. So one approach is okay, I'm going to focus on increasing the demand. I'm sorry, I went too fast here. Increasing the demand for New Orleans. So that's one potential approach, because we have a chicken and egg problem, no? Should I build or should I have people come and then build? Well, if you start with having people coming, that might help, and that might increase, if you do have infrastructure, some infrastructure and housing, and you increase the number of population, you get more population, that's going to increase the prices and increase the economic activity. But unfortunately, in a situation like this, if you go from P1 here to P2, see that in this one scenario, the final prices are still below replacement cost. Is that a better scenario? Well, it's better than P1 for sure. You brought in more people, you attracted more people, you created perhaps jobs for people to come, but you're still in a bit of a difficult situation because your housing prices, your real estate prices are still below the construction cost, which means that slowly this city is not going to have a spontaneous new construction because, again, it's not profitable to build still in this city. You have prices of real estate that are below the construction costs. So now, how about this other scenario? Well, in this other scenario, you have a demand shock that's big enough. The city becomes attractive. We create thousands of jobs. This might be Shenzhen in China. I'm not sure whether you know this case study, but it's next to Hong Kong. And in the 1960s and 70s, it used to have 2,000 people perhaps living there. And they put a lot of industrial development of China in that area. And then you have exponential growth with millions of people from all over China and actually Asia moving into Shenzhen. So if you create an enough push on the demand side, you can bring prices back to a level that's at above replacement cost. And then the market, you're going to start city flourishing. People are going to start renovating their homes. People are going to start building their own industries, building their own business, so on and so forth. So on the demand side, if you're just affecting the demand side for a city, you cannot stop whatever you're doing to improve the demand on the city. You really want to bring that demand. If you cannot do any subsidies on the supply side, because you don't have the money, you don't have the money to do anything on the supply side and build more, then if you focus only on the demand side of making the city attractive and getting more jobs, you have to go all the way and push these real estate prices to a place that's above the replacement, the construction costs, so that economy, people start building again. So I'm going to stop now for a minute and take any questions that you guys have until now. Or I'll ask if you can confirm that people are following. That'd be appreciated. No questions? I want to make sure that people are following. So if one of you can do this, it's difficult for me to see if one of you can do this or send me a sign. Okay, I see one. Good. So I'm going on. That's great. I know that you're not sleeping yet. This is good. Okay, so the demand side policies, important for reconstruction, but you have to push them all the way. Otherwise, if you stop here, as in the other circumstance, if you stop here, this is not enough because slowly you're going to have the stock. You don't have any new construction. Even if you put some demand side subsidies on firms, that's still not enough for the city to recover, because no one's going to build on the private sector unless the prices are above the construction cost. Now, that's a good demand policy. You push it all the way to a place where the prices are above construction costs. This implies something that's a bit counterintuitive, I think, for people in the public sector usually, which is you, as someone who wants to try a demand policy or a policy that improves the city, that brings jobs to the city and people to the city, you want the real estate values, housing values to go up, unfortunately. It's a bit conflicting, no? Because obviously from your public perspective, you think, oh, you want people to have cheap housing. No, I understand that. But unfortunately, unless you bring the prices of the real estate stock above the construction cost, you're not going to have any private investments. And because the needs are so large, you do need to have at some point private investments. I don't think it's feasible that all of the investments can be from the state in the next 20 years. So part of the issue here, again, is working on that demand for cities to make them more attractive. We're going to talk about this right now. So you have to think reconstruction, which is the supply side, but also the demand side for the city. So in places, and I think that the lessons are very clear with New Orleans, by the way. In New Orleans, they focus so much on reconstruction, and they did have the money because they had subsidies from the American government, and the rest of the American economy was doing fine, so they didn't have the needs that you will have, and they could actually afford to reconstruct parts of New Orleans. The problem, though, is that they didn't have enough demand, or still there's not enough demand for New Orleans to be the New Orleans that used to be before the hurricanes. New Orleans is not the same city. It's not come back to the same level, because even if you had the money for the reconstruction on the physical assets, the demand side wasn't taken care of. So here, in places at the same time the reconstruction needs are very important, the effort to reconstruct the demand for the city, it's also very important. I know that you also have a lot of population who's moved to Poland and other countries, so bringing these people back is going to be important. How do you do that? Creating trade, especially jobs, quality of life. I know that you won't have a problem because your planning is well known for such beautiful cities that you were planning in the 2000s. So you're not going to have a problem with this. You have to make cities attractive in a ways that people want to live there. And then obviously there's an issue of fertility here. Stock reconstruction can go a little bit before the men, but perhaps not too fast. If you rebuild too much and you don't have the demand, that's going to imply that the prices for the real estate are going to be so low that no development, no private development is going to happen. Okay? Which means that typically, and I think perhaps this is obvious, and I apologize if I'm making obvious points, but you really want to target for the reconstruction, for the supply side, areas that generate positive, what we call positive externalities, which means that can attract the demand for the rest of the cities. So probably to start with, in some of your cities that have been destroyed or affected, you want to start focusing on the central areas where people walk, where people shop, because that creates a vibrancy for the city that's going to attract people. Places that are accessible to jobs, historical places, and places with have architectural beauty, or you create that architectural beauty. It's very difficult. I do understand that from for a politician or elected mayor, each neighborhood is going to come and ask you, I need my new water supply. I totally understand that it's going to be hard decisions, but it is true that if you must prioritize, obviously if you have funds for all the demands, that'd be great, but if you must prioritize, I think probably prioritize on areas that are going to drive the demand for the city. This is jobs and sort of quality of life in the central areas and with commerce and vibrancy. I think that's probably the priority before you get into the specific, more residential neighborhoods. Now, so again, what is the lesson from this? In my view, and that's counterintuitive, at risk areas, one of the major policy objectives should be to bring real estate values to market valuations that make redevelopment possible. In New Orleans, what happened is, we put billions of dollars into reconstruction, but now, after we stop the reconstruction, we look at the values of those homes, and they're still below market value, which means that there's no development from, we reconstructed the city in the early 2000s, and then from 2005 to 2024, there's no new economic activity, because you know what, no developer is going to put anything there, because they get much less than what it costs to build, okay? So only when private development happens, you can then use that spontaneously market capital to actually bring the supply all the way back as you can. Okay, so here it's a little bit, you wanna, obviously, it doesn't mean that you cannot rebuild the stock initially. You certainly rebuild the stock, but unless you don't do anything else, unless you bring the people and attract the people, that's just going to mean that the stock is going to be even less valuable, and it's going to be farther away from being profitable. So then you need the demand at the same time. You need to just act on the stock, but if you can, also act on making the city more attractive on the demand side. Okay, so that's kind of the lesson. It's probably not. I mean, you may argue that it's clear, but that issue of construction costs is really important, and you have to understand what the replacement cost of your structures is in Ukraine. Okay, so now let me look at. So we now understand the interaction between the supply and demand. We now understand how important it's to get values that if your public capital cannot possibly replace all the stock, you need private capital. And in order to get private capital, you really want to focus on those prices. Now let's look at the experience of other areas that have happened to have catastrophes in their historical experience. The first one I'm going to focus is on Japan. So we're looking at Japan, unfortunately, from 40 to 47. It's well known that the destruction of Japanese cities was staggering because of obviously the war, World War II, but what we see paradoxically. So if you look here in this graph, on the X horizontal axis, we're looking at the growth rate of the city during the war from 40 to 47. And you see a lot of cities have very negative, so zero is here, meaning if you have less than zero growth, it means that you're losing population. And you have these two large cities that are losing a lot of population, more than 50% of their population. And these are the large cities, Tokyo and Osaka. And then you look at however, the growth rate from 47 to 1960. That's the Reconstruction era after the World War. So Japan is a very good example because it's an example of a very fortunate reconstruction. You had exactly the cities that had lost more population are the cities that gain more population. No? So look at the shape of this, this data. So the cities that tended to be very negative, losing a lot of population in the war, are very positive, gaining population after the war. Whereas the areas that had gained population actually didn't gain as much population. So this is a very positive scenario of reconstruction. As a matter of fact, even if you look at Hiroshima and Nagasaki, you tend to see that obviously, unfortunately, they lost a lot of population after the war because of the destruction of the city. But then if you look slowly, and this we're looking at this graph here, we have the years and the population. It's a log, which is a mathematical transformation. Don't care about that. But you have that despite the fact that they lost population, their populations catch up much faster, and they go back to the growth trend that you had before the war. This is a very positive scenario. The Japanese scenario, post-World War II, is a scenario where the cities that lost more population gain more population. Let me show you another scenario that's not as good, unfortunately. The other scenario is in after World War II also, West Germany versus East Germany. As you know, Germany gets partitioned between the two spheres of influence, the United States, the Soviet Union. So you have this partition. And what people have done, or researchers have done, is to look at the cities that were really close to the border. So if you look at the border cities here, these cities here on the East Germany side had a lot of contacts with these cities here on the West German. It was a single country. You just went from one place to the other. You didn't even think about it, no? You just go from this town to this town, you drive, and just like buy something here or take your kids to piano classes here. So there's no border between these two areas. Obviously, what the post-war situation implied is also that now we have a border between these two areas. And what researchers have done is to look at the evolution of population in these border towns that are 10 kilometers away from the border, on both sides of the border, and that's what they call the treatment group, and compare them to a control group of cities that are not as close to the old East German, to the new, really, in 47, East Germany, West Germany border. And what they find is, as opposed to what we find in Japan, here we do have that in this, what we call treatment, the observations that have been, affected by being very close by the border, they actually gained much less population than the cities that were a bit further away, from the border of the East-West Germany. So we have two similar, catastrophes. World War II, a lot of destruction of the stock, of the housing stock, a lot of displacement, a lot of demand reductions. But in one case, Japan, the cities that suffered the most were the cities that did the best and rebounded. Whereas in the other scenario, the cities here on the border of West and East Germany are precisely the cities that do the worst. And whereas the countries going back, they're becoming relatively less similar. Anyone, if you want to, can speculate about why the difference between these two scenarios? Well, there's many theories. And obviously, you have, people helping these areas in Japan, the United States, in West Germany, in East Germany, you have the different areas of influence. The one critical difference between these two is trade, the strategy that they had with respect to trade. And by trade, I mean to have these cities export, where they sell their goods, no? In the Japanese cities, they really focus on international trade and international trade. So in Hiroshima and Nagasaki, you have firms that export to other Japanese cities and to the rest of the world. So they really focus, and especially the cities that were more affected, they focus on trade with the rest of the world. Whereas the German cities in the border, they used to trade with each other, no? And that source of trade, if I'm very close to the border, 10 kilometers away, now the whole half of the population is now not buying my products anymore because there's a border separating us. So I lost most of my customers. If I'm in West Germany and my customers used to come from 5 kilometers just driving to my shop, now I lost half of my customers. And here what the Germans didn't do is the aggressive reorientation of those cities to the trade, because they lost so much trade from the closure of one side. They should have had been compensated with trade with the international world or other parts of Germany, and that didn't happen. So I think the distinction between the successful demand strategy of Japanese versus the border areas of West and East Germany is trade. It's really trade, which suggests focusing really on exterior trade and obsessively focus on attracting export-oriented firms. You obviously have to have firms that are focused on the Ukrainian market, but for the cities that are closer to that new border that's going to be implicitly there, the establishing trade with the outside world is much more even of a priority. Because the cities in your eastern, in the west of Ukraine are probably going to be much more easy naturally obtaining opportunities for trade with Bulgaria, with Romania, with even at some point Hungary, hopefully, with Poland. But your eastern cities are going to have a harder time, so you need to really probably focus more on those. That's why I think the lesson from the East Germany versus East-West Germany boundary versus the Japan experience tells us really focus on trade. And how do you do that? Well, I'm thinking here, I put a Ukrainian tiger, like we talk about the Asian tigers and the success of the Asian tigers. It was first Japan, then South Korea, and finally, you have Taiwan after that, probably Japan, Taiwan, South Korea, and then Hong Kong, and then China. And you know what? Their model was the same. It's, from a way, it's really focusing on trade, not only necessarily with other countries, but also if you have the eastern cities have to trade with the western cities. You have to have some kind of export industry. If you don't focus on that, then it's going to be really hard because they lost most of their trade patterns. So how do they do that? Well, in the case of the tigers, the Asian tigers, they really subsidize companies that locate with trading purposes only. That doesn't mean you subsidize your friends. That doesn't mean you subsidize your well-known local entrepreneurs. You subsidize firms that trade, that export. How do they do that? How did they do that? Well, free land. That's one of the secrets of the Chinese model. The land for industrial activities was offered completely free. Low or no taxes. I'm not sure what happened, but let me try again. Any questions? Okay, so let me go back and try to share. There. Low taxes or no taxes. Very pro-business government. Again, pro-business doesn't mean that you help necessarily a few people. It's the opposite. You help the competition of those few people. Okay? Pro-business is not, you have 10 people who are the industrial people and you help those 10 people. It's the opposite. You help their competitors. You help everyone. And then sort of recycling taxation. We're going to see that later when we discuss more of the potential models for finance, what we're going to do. Now, you can argue, well, we tried this in Southern Europe. I'm originally from Spain, and, we had the Franco regime, which was a fascist dictatorship. They were not that different. Honestly, if you look at their policies, they were not that different from communist regimes in the sense that they tried to nationalize a lot of the industries, make a lot of a national industrial base. And Latin America, a lot of the countries in Latin America also tried to subsidize industries. And it's totally failed. It's totally failed, the subsidies to industries. And then you ask, why did the tigers succeed on this industrial subsidy program? Whereas the Latin Americas and the Southern Europes, Italy, to the degree you can argue that some problems in France right now are still driven by this, on Southern Europe, I think more generally, is still driven by the excess concentration of industries that were subsidized at one point. Why did these people fail? Where the Japanese, the Taiwanese, the Hong Kongese, the South Koreans, the Chinese repeat this model, and now the Vietnamese are doing it all the time and always successfully. And I think the distinction is that they did not, the Latin Americans, the Southern Europeans, we subsidize a few nationalized or well-connected firms and limited internal competition. We close the country to competition, and we subsidize our own oligarchs or our own firms that were controlled by the political parties or the political movements. In Franco's case, the political movements, when Franco died in Spain, then we had the parties taking care of those political relationships between the firms. So you create actually firms that are not competing. The focus of the Tigers is completely the opposite. It's focused on providing facilities or subsidies, but not necessarily with money, but with pro-business, with land, with no taxes. You don't need even the money. But subsidize people or firms that are competing in the international markets. And these are competitive already to start with. So you're just helping. So you don't subsidize just your firms. You subsidize all the firms that can compete in the market. You do not make any distinctions or any politics. You just let the market pick the winners. It's a bit of a Darwinistic argument, you might fear, but it's the thing that's worked, in my view, personally, for these tigers. No? And again, we have now 6 tigers with Vietnam coming in, and probably going to get a 7th. Indonesia's already in Malaysia. You could argue they all did the same thing. They let these firms compete in the market with the subsidies. They provide the subsidies to everyone. Or, again, the subsidies don't need to be based on money. They can be based on these facilities, on the land, on taxation. And then let them compete. If they don't compete in the global markets, they just go. They don't protect those firms. So that fosters competition. As you create a number of critical size of firms that are competing in the market every day, they're really going to be very active, and they're going to be incredibly efficient. They're going to become incredibly efficient. And then gradually, only 20, 30 years later, you're at Japan and South Korea, and now gradually can be withdrawing those subsidies, as those firms are now really completely integrated into the international market. It's almost like a Darwinistic process, survival. You now had, out of the thousands of firms that were started because of these facilities, now you have 200 that are really strong, and they really learn, they really create new technology, and now they're already grown. It's like a plant. Now you protect the little saplings when you plant, but then as they grow stronger, you don't need to protect them anymore. They're going to grow by themselves. So that's an important, I think, lesson from the tigers. You have to think about European accession, by the way. And I was thinking when I was thinking about the comparisons between the tigers and the Ukrainian tiger, is the European Union. You have to be careful because the European Union has it's a process, obviously, but they have policies that really do make it very difficult to do these subsidies, because they don't want, Spaniards and Romanians to compete from the same firms. So that's something that you have to think about, what the process of integration with the European Union is going to be that makes this tiger strategy compatible. Obviously, in 30 years, you want your firms to be strong enough that don't need subsidies. I don't think this subsidy or implicit subsidy strategy works forever, and shouldn't. But, certainly the path or how you're going to get there within the European Union that has very clear rules against industrial subsidies because of competition between the European Union, something that you're going to have to think very carefully. So that's it for my economics, the main economics of a reconstruction situation. And I'm now going to go into the tools for finance. But before I do that, I'm going to perhaps stop 1 minute for questions.
В нас є два питання.
We have 2 questions. They
Це
are
від
in the chat.
Тетяни, і там є ще без
This
підпису,
is
будь
from
ласка, якщо можна
Tetiana, and there is one more question without a name. So please go to the chat and read the question.
So no questions. I totally
Do you-
understand because it's difficult to
do you-
create the environment from. Oh, okay. Can you
Є два
please
питання, і я їх
There are
змістив.
two questions, and they are in the chat. They are in English in Zoom chat. So please, Mr. Albert, could you please read the questions?
Yeah, okay. How to minimize the risk of developers refusing to build in the occupied territories?
Як
Yes,
зменшити
again,
ризик девелоперів, щоб вони не
there's
боялися
two-
будувати на деокупованих
Developers will not
територіях?
build unless they make money. That's the reality, and they shouldn't. But maybe your questions are gonna be more related to my second part of the talk. So, in your opinion, from what source will Ukrainians be able to track money for the reconstruction? That I'm gonna talk about in the second part of the talk. And there's another question about. I really wish we had subsidies for everyone. You're right. You're not. You're not gonna have subsidies for everyone. So that's absolutely right. So I think your first steps, at least 5-6 years into reconstruction, are going to be targeting, and prioritization. So really to prioritize the products, and those are probably industrial products. So unfortunately, and this is going to hurt your hearts because you're going to have so many needs and so many people asking you, how about my neighborhood? How about, and those people need and require, and they're as important as anyone. But unfortunately, you're going to have to prioritize and really focus on activities that can bring finally employment and jobs. So my sense is that in the reconstruction process, you're going to have to be very, very explicit and very clear to people that you're going to have to at least prioritize employment and jobs for the first 3-4 years. So again, developers here refusing, you're going to have to work on what sectors are profitable and sort of like focus here again on the export side and focus on those sectors to get developers to be interested in even investing there. I mean, obviously, and you know much more than I do, but I'm going to speculate here. You have obviously now sort of like a number of sectors and segments that you're going to be the best in the world, like in defense, you're going to be the best in bio, you can be the best in agriculture, in agricultural technology. You have, a number of advantages that definitely can help you. You also have something going on for you, which is the conflict of the West with China, which means that if you provide a safe alternative or relatively safer alternative for this offshoring of products, that can work. Obviously, it's a very difficult challenge, and but you have the best people in the world, so that's going for you. So I'm not sure I answered the questions, but I'm going to move to the second part because some of the questions are really related to what I wanted to talk next. So let me shift gears to that second part. I'm going to talk for about 18 minutes, and then we're going to have a break. So what I want to do is to share again and move into the more the questions that you ask. Where can we get the money? No, who's gonna? So let's try to think. I'm gonna think, or we're gonna think about what are the tools that people all over the world use to finance projects. Whether which tool is better, I don't know, or which tools you're gonna be able to access. It's a lot of uncertainty, but at least I want to show you what other people do. So the first thing I want to do, and relatively quickly, hopefully, if you have seen a finance calculation, it's going to be easy for you. If you haven't, probably someone can teach you. I'm going to go very quickly through this material, which is what is discounting, no? And, that's how the way capital markets and lenders, because you're going to have to deal with lenders for the next 10 years, I promise you, unfortunately. So you're going to have to deal with lenders. So I want to show you how lenders think. It's quite simple. So if, say, I invest $100 today and the interest rate is 10%, well, that means that if I get an interest of 10% after a year, if I lend 100, I'm going to get back 110. So I'm multiplying the 100 times 1 plus the interest rate. In this case, the interest rate is 0.10, which means 10%. Here we're expressing this as a fraction of 1. So to think of a percentage, you multiply by 100. So 1 plus the interest rate, in this case 10% or 0.10, is going to give me the value of $100 that I lend for a lender in the future. That's how lenders think. Very simple thinking, okay? I'm lending you 100 and I'm going to get 110 next year. Obviously, if I lend you a second year the same amount, then I'm going to get 100 plus the 1 plus the interest rate, which is the 110, and then for the extra year, again, I'm going to charge interest, because if I lend you the 100, next year you owe me 110, then I have to charge interest for the 110 on the second year, okay? So if you didn't pay me on the first year, the 110 back to me, then I'm implicitly lending you 110 again on the second year, which means that then I multiply by 1 plus the interest rate, this initial quantity at time 1 of 110, and then I can express this as 110 times 1 plus the interest rate to the square root. So now it's 110. If I lend you the money for not 1 year but 2 years, on the first year you owe me 110, and then because I lend you again this 110 until the second year, you owe me that 110 times the interest rate on the second year. That's 121. Okay? So that's what we call compounding. The interest rate affects not only the original 100, but then because I owe you more, given the interest that accrued, that happened on the first year, then I have to pay interest not only on the 100, but on the 110 on the second year. That's called compounding. Obviously, I can do the same logic for 3 years, and then if I lend you for a third year, I'm going to obtain, as a lender, I'm thinking as the lender logic, I'm obtaining 100 times 1 plus the interest rate to the power of 3. So obviously, if I lend you for 4 years, I want, again, the same cumulative, and you can see the logic here. Now we obtain a formula. That's great. We're at MIT. We love formulas. So now you get, if I lend you money for n years, n might be 10, might be 20, whatever it is, it's just a number, n of years. It's an integer, positive. So then I need to multiply by 1 plus the interest rate and exponentiate, to do the exponential to the power of n, to know how much I need to get back in the future. So that's what we call the future value of money. If I lend you X dollars or X euros, say 100 million euros, then in n years, maybe 20 years in the future, I'm going to require you to pay 1 plus the interest rate to the power of n times the initial lending. And that's when it's going to be what you owe me, the future value of that lending for the initial value of the original loan. Okay? So I'm going to use this compound interest to fast forward the value of money. If I lend you 100 today and you don't pay me any interest, I want in 20 years, maybe I want 300 back, because that's accumulating the interest. That we're going to call future value. Now you see, this is kind of amazing, because now we have a calculator that goes from the future, you have a future value, to the present. So if you give me a value today, I can give you how much you owe me at that interest rate in the future. But now obviously I can divide both sides. I can do the opposite. If I divide by 1 plus the interest rate to the power of the time difference between this period, I can bring future values to values today. So if tomorrow I'm going to get 300 million euros in 20 years, what is the maximum lending or borrowing that I can do today based on that future value? A lot of what you will be doing is this. You're hoping and you're pushing, you're working, and you will get the value of your cities, the value of your industries, the value of your employment in the future to be very high. In 20, 30 years, those cities in Western Ukraine are going to be amazing. They're going to be highly employed. They're going to be sophisticated. But obviously, you need the money now to do that. So that's basically what you're going to do. You're going to have to deal with financial institutions and investors to get that future value into today's money. But obviously, that takes a cost, which is the discounting cost. So a lot of what in the reconstruction setup is going to happen is to make sure that you, in a way, promise some of this future value of your cities to get money today or tomorrow after the war. So you have to convince people that there's this value, okay? So that's important. So you're probably going to be cheerleaders, and you're going to be probably also like pushing and believing. You need to believe yourselves, because otherwise people won't believe. And then once people believe, you have to find ways in which you can structure that lending. And that's what we're going to talk about right now. Okay? But this calculation, by the way, is called discounting. Okay. So what is the discounted cash flow? Well, you know, in any financial calculation, what you're going to do is to look at the values of a cash flow. No, this might be, say, payments for a mortgage, and then discount them using the formula that we show. If something is going to be paid 1 year in the future, I'm going to divide by 1 plus I, the interest rate. If something is going to be paid back in 20 years, say N is 20, then I'm going to discount it by 1 plus the interest rate to the power of N to get me what's the net present value of that cash flow. So I'm going to sort of like generally, as a matter, you know, I'm going to calculate the net present value of these future calculations that I do about, say, a mortgage or any cash flow that you have by dividing by some kind of interest rate. Now, once I do that, I'm going to look at cost-benefit analysis. What a cost-benefit analysis does is puts together, it's a very rational way to go about prioritizing in reconstruction activities, prioritizing the expenditures and the debts. Because obviously the needs are so large. You know that the needs are so large. So you need something of a, at least analytical tool, or, you know, even for transparency, you need to be transparent about what the priority should be. Okay, to do that, typically what economists tend to do is to do cost-benefit analysis. So the costs are very clear. They might be from the mortgages, from the lending. Whatever you get to finance a specific project, you know what the cost, how many euros you're going to have to pay to a German development bank or the Polish government to actually repay that loan. Okay, so that the cost is very easy on this cost-benefit analysis. So if I'm going to do this water plant treatment, I have to do this water plant treatment and sewage, and you know the Polish corporation, it's going to lend me 20 million euros to do that, and you know they're going to every year they're going to charge me this C1, C on year 1, C2. I got a very clear schedule from the payments from them. That's fine. The costs are usually not difficult to know of this kind of like major redevelopment or reconstruction projects. The more difficult aspect of this is the benefits. No? What are the benefits of these projects? It's very difficult because you have so many needs, and they're all deserving. But certainly, you know, to do a rational process, you have to put some kind of prioritization. There's no way around. There's too many needs. So you're going to have to put some kind of number from the benefits. This might be, obviously, some of the criteria here are how many people are served. So the more people are served, I'm going to put, for each person, it's a 10 euro value. Whatever, those values sometimes are disputed. People dispute whether what's the social benefit of something in euros or in hryvnias. It's difficult, no? But at the very least, by doing a process that's very explicit, you're making your assumptions explicit. Even if you and I disagree, maybe you think the benefit's 10 euros, I think the benefit's 30 euros. That's fine. We can try both 10 and 30 and see which projects under both the scenarios would still have the highest cost-benefit analysis. Okay? So I think people sometimes think of cost-benefit analysis as very, I'm putting a cost on something that doesn't have a cost or a value. Well, you are already, if you're making these decisions and you're prioritizing one investment versus the other, you're implicitly putting already a different value on one or the other. So this is just a way to put it transparently, to do it transparently in a way that maybe, even centralize, that everyone sees what are the assumptions that you're making. Obviously, the benefits of a project such as a water treatment plant are going to be higher in an area where there's more people. They're going to be higher in an area where you have that potential for the water to be used for export industries that then create more demand and create employment, so on and so forth. So these numbers are difficult to come up with, but some kind of process where you compare the benefits of one project to the other has to be done in a rational way. Okay. Then if you could put a number on these benefits and these costs, then the classical cost-benefit analysis implies that you subtract the benefits from the costs and you discount that cash flow in the way that we just taught. Okay? And then, in theory, you're going to be choosing projects with the highest benefit to cost. Okay? So the highest number, this higher net present value. Okay? Again, I'm not arguing this is easy. It's not, because the benefits are very difficult to quantify. But again, you can think of this as a scenario building. What if I think the benefits are 100? What if the benefits, and then you can at least look rationally at what's the costs and benefits of the different projects. Obviously, it's difficult to always forecast future costs. Some of them are financial, and you have them, but some of them you don't know. This is very difficult. What's the value of improving the water for 100 people? If you ask me, I don't know. It's infinity. We want everyone to have water. The problem, though, is that we're going to have millions of people who need water, and we're going to have to prioritize. So then we're going to have to put some kind of valuation, even if we don't like that. What's the appropriate discount rate? That's going to also depend on the cost of capital. No, if you get cheap capital, you're going to be able to do more than if you get very expensive capital. So it's going to be critical on how your financing sources are going to be. There's a lot of uncertainty about this, obviously, depending on whether also the European Union, you get funds to the European Union, the European Reconstruction Bank, the IMF. It's going to be the cooperation from different countries. The more risky projects should mean that you have more expensive capital, so the more uncertainty, usually you put a higher discounting because you don't know what's going to happen. So if something has very large benefits but very far in the future, given that it's very risky, you probably can put a little bit more of discounting because, it's difficult to know what's going to happen. And this exercise, I don't think it's so much, honestly, for the valuation of benefits and costs. It's a transparency exercise. It's a transparency exercise where you show people, okay, we're putting this weight into this, into that. And, we can disagree, but we cannot do everything in the next 3 years. It's not going to happen. So we're going to put priorities, and we're going to put priorities based on this analysis. We can argue, and we can come back to the process, political process, and come back with different values. But once you have different values and you do the analysis again, then you have another set of priorities, and you go ahead with those. There's no other way around it because you have too many needs for the next 3 to 5 years. Okay, so that becomes a little bit of a process. Also helps you in a little bit of a political way, as a rational way to actually go through this process. Okay, so then what's the general principle? And again, this might be obvious, but the general principle is how to get the maximum net present value, the maximum, the difference between the benefits and the costs at the minimum cost. That's what you have to think about. So let's think about something that's called an efficiency frontier. And here I'm going to have the social value of the projects, and here the cost, the financial cost of the project. So very costly project, say a nuclear plant, that's very costly, that's very expensive. A less costly project, maybe water treatment, a local water treatment for 1,000 people. Okay, that costs maybe 2 million euros, whereas the other costs 200 euros. So you're going to have projects that you're going to have to trade off the value of the project for the cost of the project. And you want to it doesn't mean that you don't want to do big projects. There might be some really good big projects that you can do, but you want to be always at the most efficient frontier, which means the trade-off within these projects, I'm going to show you an example so that you see this, it's a good trade-off. So let's look at 3 potential projects. Project A, water treatment facility in an area with a lot of population. Well, that has not so much cost, and if I look at the overall benefits, the overall benefit minus cost, it's very high. So I do the discounted sort of cost-benefit analysis, and for, say, 3 million euros, here I get a very high social value. Maybe I'm going to look at a nuclear plant here, which is like 100 million investment, but if I do the nuclear plant, maybe I find C, and I find, you know what, the social value here for this 100 million euros was very similar to the water treatment plant that maybe is treating 20,000 people. And here for that huge cost, because I don't have a lot of finance available in the next 3 to 5 years, for the very same cost, you know what, if I got 100 million euros, I might do 33 of these water treatment plants rather than one nuclear investment here at C. However, there might be other projects like B that are more difficult. No, these might be roads, investing in all roads, the reconstruction of roads in all sort of the western area. Yeah, that might cost a lot of money, $100 million, but you know what? You get much more benefits. These are much more difficult to choose between A and B, no, because here you spend much more money, say from 3 million to 100 million, but you get much more value from A to B, okay? But what you really don't want to be doing, these are difficult projects, no? You have to come up with some kind of, again, the cost-benefit criteria. But there are easier projects like C, where you go, given that I only have, this is a nice project, gives me benefit, but you know what, this is much cheaper and I get the same benefit. So that's why a rational process where you qualify a number of potential projects, not just go one project at a time, look at a portfolio of projects and then do a quick analysis of the projects and then focus on the ones that have the highest social value for the cost. So you're going to start with this nuclear power plant. Maybe we leave for later because right now we don't get so much value for this. But again, the transparency of doing this in a public way in which you put costs and benefits also gets you credibility. And again, because you're going to have to choose between these projects, you cannot do the 3 of them. Okay? Probably to start with. Probably you want to start with A, then probably when you have more money, go to B, and then finally, only then later, go to C. So, cost-benefit analysis, you have so many needs. You have so many needs. So the only way to go about them is to use some kind of rational choice paradigm, I think, in a way that maximizes. So you're going to have, in my view, or in a reconstruction view, I think it's a good idea, and that also works for New Orleans, think about a large set of potential interventions. Because, you know, you're going to have a lot of demands. Okay, I need this water, I need this thing, I need this. So I think it's better to think of not just for each small intervention, but to have at least some kind of centralized decision making between the different agencies. You have a different set of needs, and those needs are put up to a higher layer of decision making. Each of your departments in the city, you have 20 departments, sports, education, health. Each of them send their needs to the top, and the top gets 20, 30, 40, 100 needs from each department, and then you have to have some kind of, once you have this, do some kind of ranking in terms of cost benefit. You're going to have to prioritize the interventions with the highest cost benefit. This doesn't necessarily mean the largest interventions. Maybe you do start doing smaller things first. I think water and sewage seem like pretty obvious in terms of like sanitation and health of people. And then keep doing this until your budget is exhausted, which means that some needs are not going to be, unfortunately, be able to be solved on the first 3 years, but then you put them in the next period. So with that, I'm going to stop here and perhaps get a break, and I'll see you back in about 15 minutes at 10:40. Is that fine with you? If you have any questions, leave them, and I can address them as I come
Є
back.
ще одне запитання, воно перекладене англійською мовою.
We have one question. It is in the chat. Albert, if you can read that, it's the last one.
So let's see, we're fine for a break, are we? Okay. So I'll see you at
Albert, excuse me. We have a question for you in the chat. How to calculate social value? Should it take into account surveys of residents?
Right. That's the big problem in this cost-benefit analysis. Whatever decision you make, if you have to choose between a number of projects, you're already doing that. So I think the only issue is the transparency of the process of putting these costs and benefits. So if you have say you have 3 projects that each cost 1 million euros. First, neighborhood 1, neighborhood 2, and neighborhood 3. They all need the roads. That's 3 million euros, and you just have 1 million euros. You're going to have to do one project only. So you can do it without a rational process and say, okay, neighborhood A. Or put some kind of number saying, okay, there's 10,000 people in neighborhood A, 3,000 people in neighborhood B, and 500 people in neighborhood C. So if each people, I think the benefit of this is 100 euros because, I just put a number that maybe it's a bit assumption. That immediately is going to tell me I should start with a large area. Not only that, but my process is now transparent. I'm not going to get if my friend is from neighborhood A, and I go to the president and say, oh, neighborhood A is being so affected. I'm so sorry for people in neighborhood A. They need it. Well, that's not the right argument, is it? Like, you wanted that transparency. So I think not so much, the values are important. And you can use those values from their publications from the World Bank and things like that put numbers on those cost-benefit estimates. But I think the most important part is the transparency of the process of doing these decisions, from a transparent way. Any number that you put, if you have a place that has more people than another, it's going to need the intervention before. So even if you think, oh, the benefit's 10 euros versus 30 euros versus 40 euros, it doesn't really matter because if you have 10,000 people here, 1,000 and 500, you're always going to choose the 10,000, no? It's really, so I think it's about the transparency of and obviously that's a real problem in cost-benefit analysis that's well known about and how we put these values. But certainly you cannot put values that people cannot pay for. So obviously if you put a value of $10,000 on the water of everyone, well, people are not going to be able to pay $10,000 ever. So that's not a realistic value either, So you certainly have to put some values that you think that people eventually, when the economy is reconstructed, are going to be able to pay for that service 5-10 years in the future. Okay, but again, I think that this cost benefit is more about transparency and more about, because everyone's going to be caring about their needs. It's human. It's normal. That's what they should do. We all care for our families. So, but you need also a way to, even psychologically, to be able to cope with so many demands by having a process that's very transparent and rational, that then you can point to the process so that everyone understands what the process is. And I think that's going to save you a lot in terms of transparency and decision making, improve your decision making.